Hey everyone, this is John here with you. It's the 12th, Tuesday evening at about a little bit after 8 p.m. We're going to go ahead and do the second update for this week. There may be a third later in the week depending on what happens. And I know these two are pushed pretty close together. The first one was on the 10th on Sunday night, and here we are just on Tuesday, and I'm doing another one. But the reason is that there was a really good opportunity yesterday for a new position. I wanted to point that out to you all before. I didn't want to wait, 2-3 days down the road and then go back and say, hey folks, look what showed up on Monday. So I wanted to show you this as quick as possible. So we're straying from the norm just a little bit and doing the second update Tuesday. A lot of times the first update isn't done until Tuesday, but that's not the case this week. I try to do my best to be flexible and whatever the market gives us or does to us, react to that and try to get an update out that's relevant for what is going on. So that's what I'm attempting to do here tonight. So again, as we go through this, please remember the disclaimer. Everything that we do here is for practice trading only and for educational purposes only. Nothing that we cover here should be considered any kind of advice about your own trading activity, nor should you be trading any of these positions with your own money. Nothing that I cover here should be considered any kind of suggestion as to what you should buy, sell, trade, anything like that. I don't have a license to do so, so I'm not permitted to do so. All trading does involve a risk of loss. It's always the situation, and I could possibly have any of these positions on at any time without saying so. Now, what I want to do here is first, I want to look at this position. This is the one that we had on, and I'll show it here on the chart. It's this trade right here, okay? It's this trade that we covered last time. We've had this on the Market Insights, and what we did during the last update, and I'm gonna stick this on here. We talked about buying this butterfly right here, and it would be a buy to close 3 of the 1890s, and then sell to open 6 of the 1865 puts. These are puts, of course, and then the other one is buying to open 3 of the 1855 puts. Now this was done for a debit, right? This was done for a debit. So look at this very carefully here, and I want you to make sure you understand exactly what was done here in this trade. So that's it right there. Buying to close those 3 1890s, then selling to open twice as many, 6 of the 1865s, which is below 1870, and the buying to open 3 of the 1855s. So what we have here is this butterfly here, and I'll show you here. Now these prices are not accurate. These mid prices, that's the current mid prices right now. So what I want to do is go back. I went to the last update to see what the mid prices were on Sunday night's update. So that's what we're going to use here. So I'm just going to go in and fill these in as fill prices of what each option was going for at the time. And if you go back and look at the last update, you'll see these on the screen. So that one was a mid price. The 1890 was a mid price of 25.45. The 1865 was a mid price of 18.30, and then the 1855 was a mid price of 16.05. So there we are. That's it right there. Now, and now I've got them filled in. Yeah, 12.92. That was the total debit in the thing. So we can look at this right here, and I want you to notice, without doing anything else right now, this thing is right at about we'll call it $200 even. Well, 198. It's right at 198, and our downside risk now is only how much? It's only about $800. Okay, so if we do, and the reason is we had that risk on the downside where we were actually we had 20 points of risk because we were short this 20-point spread. And when I say 20 points of risk, I mean a 20-point wide spread, but really it was times 3 because we own 3 of these spreads, so it was 60 points of risk. And what we did with this butterfly here is we reduced that down. I'm going to change these strikes here, but we reduced that down to 5 points of risk. So we actually took the downside risk off quite quite a bit, down to 5 points. And the reason we have 5 points of risk on now is because after buying this butterfly right here, we now own an 1870, 1865, 1855. So we're long 5 points between 70 and 65, and short 10 points between 65 and 55. So we have 5 points of risk times 3, so that's $1,500, right? That's $1,500 risk. But what we can do is we can take that $1,500 and subtract whatever credit we have left over. Now, how do you tell how much credit you have left over? Whatever this flat line is above the zero line is how much credit you have. So here we have, roughly about $720 or so. So if we take $1,500 and minus about $700, that gives us $800, right? Which is about what the risk is there on the bottom. So based on the profit here, 198. If we divide that, and again I'm ballparking the numbers just a little bit, but if we divide that 198 by $800 risk, that's a 25% return we have right now. Now it's really not a 25% based on their initial risk, but based on the risk we have now. Well, based on the downside risk, it's about 25%. Now obviously we have more risk on the upside. At this point, we have 1292 risk on the upside. So if we divide that same 198 divided by 1292, that's still a 15% return if you base it on the upside risk. Now, something else we can also do here, we don't have to do, but we could if we chose to, is we could come in here and look at selling back this 2010 1990 spread. Okay, we have a week and a half left in this. I don't think the market will make it up to 1990, but when it starts to bounce, we're really oversold here, obviously, and we've just gone straight down. So we could be bouncing here, and if that happens, it could shoot back up to 1990 in no time, and you've got to be really careful of that. Don't say it won't happen, because as soon as you say it won't happen, it will happen. And that spread is pretty deep in the money right now, so we want to hold on to that value. So what we could do, we could simply come in here and simply sell it back, right? We could sell it back, and let me just pull this up and see what that spread is trading for. So again, this is the January 22 expiration. So let's look at that. So we would be selling the let me just get this straightened out here, then I'll repeat it. So we would be selling back the 2010 and buying to close the 1990. So if we sell to close the 2010 put and we buy to close the 1990 put, that is going for exactly what? A $17 credit, right? A $17 credit. So $17. So let's pull this one back up now, and I don't think we can add 2 lines to that. Nope, we can add 1 but not 2. So let me put you on pause here 1 second. I want to reconfigure something. Give me just a minute, please. All right, sorry about that. I was trying to find the easiest thing to do to show you the what the profit would be on this, since I can't add that many more lines into the options analytics. So here's what I did. This butterfly here, to butterfly this off, which we did last update Sunday night, was going for 490, right? It was going for 490, which is times 3. That debit of 490 times 3 is 1470. Now how did I come up with that 490 debit? Well, just keep in mind what the prices were. So this one was bought for $25.45. This one was sold, so I'll put a little minus sign there, for $18.30 times 2. Right, that's times 2, so that is $36.60, right? So that's $36.60. And then the 1855 put was bought for $16.05. $16.05. All right. So that's how I came up with that with that price. So 25.45 minus 36.60, and then add the cost of 16.05 to that to buy those other three. And that's $490. That's what it comes out to, $490. And that's per contract. And we bought 3 of these, so times 3 is $1470. Now keep in mind on this overall trade, we took in a $1.78 credit, and the way we did that was the unbalanced condor was on for even money, and then the top here, the call spread was on for a $1.78. So what we have now is $1470 in cost to butterfly this off and only leave 5 points of risk, take a lot of the bite out of the trade. So right now our total cost basis is what? It's $12.92, and the way I'm getting that is I'm doing the $14.70 cost minus the $1.78. So our cost basis right now is $12.92. Now here's the deal. If this thing stays somewhere around this area that it's in, right in here, let me take that off. No reason to have that on there. So if this thing stays somewhere below 1990 but above 1870 for the duration of this trade, everything on here will expire worthless. Again, below 1990 but above 1870, everything on here will expire worthless, with the exception of this spread. It will expire with 20 points value because that's 20 points in the money. So here's what we're looking at. If we let this thing expire in the money, and that's still 5, 6, 7, 8 trading days away. So is it going to do that? I have no clue, and you don't either. None of us know where it's going to go. I feel like it's probably going to bounce pretty hard, and that's why we need to take some action on this. But if this thing expires somewhere below 1900 or 1990, somewhere below 1990 but above 1870, we'll make 20 points on this one right here. Okay, so what we can do is we can take that 20 points and subtract our cost basis of 1292, and we'll make 708 on this trade, which is excellent. That's really good. Okay, that's really good. But here's the kicker to this. I'm sorry, I'm just doing some quick math. So here's the kicker to this thing. If the market does bounce on up, and this could happen in one day, folks. As much as we're down, this could happen in one day. If the market rallies on up really hard, we're going to give back this 20 points little by little, and it could happen pretty quickly. So right now, if we wanted to go in here and sell back this 2010-1990 spread, we could do so for how much? For $17. That's what it's going for right now, is $17. And I showed you that on the risk graph just a minute ago. To sell to close the 2010 and buy to close the 1990. So here's where that would leave us. We have a cost basis of $12.92 in the trade. I'll show you how we figured that. And if we take that $17 and sell that spread back for $17 and subtract their cost basis of $12.92, that would lock in. I'm just going to keep repeating myself until I get this typed. That would lock in a profit of 408. Okay, so that's $408 on a one contract example, and then what would happen here is this trade here would be gone, right? This spread would be gone. You have no more income potential on this, but the only thing left to manage would be this little 5-point risk broken wing butterfly. That's all that would be left to manage, which we can handle, right? We can handle that. So we could do that and lock in this 408. But if the market turns around and tanks on us, we would have to roll that 1855 up or one of the 1865 shorts down. Roll 3 of the 6 of these down, or roll. Let me spread this out so we can see it a little better. Now, what's the problem here? There we go. So if the market tanked on us, we would have to roll. The simplest thing would be roll this 1855 up. Now we could try to butterfly it off again. Probably getting a little messy at that point, but right now, there's $200 profit on this divided by about an $800 risk. Well, like I showed you on the risk graph a minute ago. So that's really good. But the other thing we could do is we could sell this put spread back out right now, and if the market went on up, that we have no rush or no worry because we have this 408 locked in. Okay, I know that's wordy. I know it's a little complex for the new ones here, but folks, just follow along and hang on with us here, and you'll start to get this. So that's what we can do. Now here's the thing. If we just get out right now, if we just get out right now for that $198 profit we had, divide that by about roughly $800 of risk, that's 25% based on risk. 25%. So and something I've got to point out is the market has been terrible. This has not been an easy put it on and don't worry about it type trade. The market has been terrible. So let's actually move. Speaking of learning opportunities, let's move on to something else here. I want to go to a new chart, and I want to show you something from yesterday. Okay, I want to show you something here from yesterday. The SPX came down yesterday, and it hit a low here, not right at 1900, but it was pretty darn close. Okay, so it hit a low there. We'll just call it 1984, but it hit a low there, and and at that point it just bounced. And there wasn't really any significant resistance there, or support. There wasn't any real significant support, except for just the psychological 1900 level. The market seems to react certain ways around big round numbers, 1800, 1900, and here it hit 1900, and on a dime turned around and bounced. And by the time it bounced here, then came down and rallied on up, that was a pretty darn good sign that it was going to hold that 1900 level. Now tomorrow we could wake up and the thing break below it. I'm not saying that's impossible. That could happen easily, but at this point when it hit 1900 and started to bounce up, I was actually watching this, and again, I don't sit in front of the market all day and watch tick by tick minute candles. I don't do anything like that, but I was interested because I was looking for something new to talk about here, and here the market did this, and so when the market was right up in here, I said, you know what, let's look for something new. And this was a golden opportunity. And hopefully it turns out to be a good trade in the end, but we're going to practice it here. But when it looked like it bounced after coming down all this way, here, it bounced on this low here of about what's showing 1901.10, but we'll just call it 1900. It bounced, and then we had a little bit more of an update today. Where's it going to go tomorrow? Again, we don't know. I want to make that very clear. But, we're pretty oversold, so we should expect some kind of bounce. So what I was looking at doing, and I'm going to graph this out here for us. So this is another great opportunity, I think, to do this, is on the SPX. And I'm going to show you here what I was looking at on a 1x3. And this is for, let's see here. Let me look just a second. So this expires the 5th. So these are the February week ones that expire the 5th. All right. Now, what I was looking at on a 1x3, and again, only 1x3 rather than a 1x4 or 1x5, because the market is still, it's just very volatile, and it's being driven by China and oil, and I just tend to be a little more conservative. But what I was looking at here, about the time the market bounced, So if we look at the daily candle, it was on this day here. This was just yesterday when the market hit that 1900 low and it started to bounce, and it was back up here about 1913, 15, somewhere in there. I was looking at a trade, and again, if you were doing this on your own and you pick slightly different strikes or got a slightly different credit or debit, no big deal. It's really not. It's really not a big deal. But what I was looking at was a 1910, 1890. So 20 points wide there. We want to keep it equidistant on the short puts. A 1910, 1890, and the shorts were at 1800, 1780. 1800, 1780. All right, and here are the fill prices that I was looking at. I jotted these down: 4170, 3418, and these are the mid prices of the options themselves: 1352 and 1103. Okay, so those were the fill prices there. So let's look at this. There we go. And that's what it was coming up to, was a 5-cent debit. So look at what we did here. We bought a 1910 put for 41.70. We sold an 1890 put for 25 even. I'm sorry, 34.18. And I was looking at the wrong line there. I know that didn't make sense. And or the wrong column, rather. Yeah, I was looking at the wrong column rather than the right line, wrong column. And then the 1800s were selling for 1352 mid price, and then the 1780s were being bought for 1103 mid price, and that comes out to a 5-cent debit, just a slight debit, no big deal. No need to get anxious because we put the thing on for a debit rather than a credit. And again, that was when the market was right around here. I don't remember the exact price, but it was in this area here. 13, 15, right in this area here. So what we did, looking at this, what I wanted to show you is this trade on a 1x3, looking like the market had bottomed out and bounced. Could be wrong. Still could be wrong. We all know that. But and there's the $5 debit over here. So so on the graph now, here is our 1910 long put, one contract. Here at this point here where it flattens out is our 1890 put. So there's our 20-point spread that we own right above the zero line. The zero line is right there in the white dots. And if we come down here, here is our 1800 3 puts that were short, 3 contracts, and here's the 1780s that were short, or that were long, 3 contracts. So we own one 1910, we're short one 1890, we're short 3 1800, long 3 1780s. So say it with me now. How much risk do we have in this thing without going over the graph and looking at it? Well, we own one 20-point wide spread, but we're short 3 20-point wide spreads. So it's really like we're short 2 overall. 2 times 20, 2 contracts times 20 is $4,000. Add onto that a 5-cent debit, a nickel debit, and what do we have? $4,005 on the downside risk, and that's our max risk. See how neatly the numbers work out? $4,005, and I'm looking over here on the right in red when I scroll over the bottom here. If I can get it back right there, $4,005 in risk. Okay, that's our risk on a 1x3. Now, right now the thing's $55 profitable. So very, very little, right? Very little. So it's actually 1.4%. If you want to be exact, it's 1.5% profitable after 24 hours. So we've just made what a CD would pay us for a year. Actually a little more than a CD would pay us for a year, and we've done that in 24 hours. So you might not be impressed by that, but I think it's fairly neat. So what we have here is that if we go forward just a little bit. Watch the purple line there. See how it starts to hump up for us? And so if we go, a week and a half into the future, and we're along this area here, we could have, $260, $280, $300, something like that in profit. And let's say the market is right here at 1915 roughly, right? We have about 283 in profit. So if we take that 283 and divide it by our downside risk of 4,005, that's a 7% profit, all right, or a 7% return. So what we're doing here is we're going to let this thing decay some. If you look up here at a theta, let's see what it looks like. Our delta is nice and flat. It's 0.01, so that's perfect. That's what we want. Just very so slightly positive, but perfectly fine. And our theta is a nice 18. So this thing's burning $18 per day right now, and that will change. That will grow. That theta will get ramped up as we go forward in time. And again, this is just a 1/3. If we did it 10/30, the theta would be $180 a day. Not 18. It would be 180. You've got to move the decimal point 2 places to the right. So it's really that 0.1819 is really $18.19 is what that's burning for us per day. $18.19, and that will go up tomorrow, will go up the next day, and the next day, depending on how the market moves. But overall, that theta should stay nice and positive for us. So we're going to put this on as a practice trade. It's already a little bit profitable, 1.7%, I believe I said. So, but and if the market expires anywhere above the trade, which is above 1910, anywhere above that, doesn't matter how far above it, anywhere above it, we could potentially lose how much? $5. We could potentially lose $5 because we have a 5-cent, or we have a $5 debit. 5 cents times one contract is $5. So we'll lose $5 on this. Now, so hopefully that's no big deal. But if But if that happens, if the market does come way up in this area, if it bounces really hard, we'll probably do a couple things. Number one, we'll most likely sell some calls against it after the market bounces. If the market doesn't bounce, if it just hovers around, we'll stay right where we are. We don't have to sell calls against this. There's no law that says we have to sell calls, because the trade will work perfectly fine all by itself without selling calls if we just let the time decay do its thing, which you can see. Now, if the market does move up some, we could sell calls. The other thing we could do is we could roll these short spreads up. We could roll up the 1800s, 1780s. We could roll those up some and bring in some more credit, which would give us more credit as potential profit, and it would crank the theta up some more if we bring our short spreads up closer. And then again, if the market starts to fall down, if it happens later in expiration, we could be in for some really nice profit here. Right? Like what if the market on 131 was here at 1871.93? We would have about $938 profit. So if we take that 938 and divide it by 4,005, that's a 23% return. And that's without selling any calls at all. So there's no reason to hurry and sell calls. Let's let the market see if it can bounce quite a bit, and then we'll use that opportunity to sell some calls against it. But right now, we're in perfectly good shape. So no reason to really do anything at this point. And again, if the market would finish somewhere below 1890, which is right below our put spread that we own, but above 1800, which is where our short spreads are, anywhere along this mountain, if we would be lucky enough for this thing to expire up here, and we didn't have to adjust it ahead of time because we were fearful, or from a drop that happened too early in the option cycle, we would make exactly $1,995. Why? Why $1,995? Because our 20-point spread would be in the money on one contract, so that would be $2,000 minus the $5 debit. So anywhere we finish below 1890 but above 1800, anywhere in here would give us a profit of $1,995, which is pretty darn good if we base it on our downside risk of $4,005. It's a 50% return. We'll round it up, 49.8%. So a 50% return if the market can finish up in that area. But most likely, if it falls so far, we're going to end up adjusting this thing for safety reasons. But right now it's in perfectly good shape. But I want to show you a little mixture of, if you are available to watch the market and you can glance at it, you don't have to stare at it, but you can glance at it a few times a day, and you see the market down around 1900 or 1800 or 2000, a nice big even number, watch that area, and if it hits some bounces, which it did, that's a pretty good indication that that's a psychological level with traders. They're going to say, okay, enough selling, let's buy. Why? I don't know. They just get tired of selling, so they decide to buy. So the market bounced a little. Now hopefully it'll continue. We can sell some calls against it, but if it doesn't, we'll deal with it either way. So this is going to be a start of a brand new trade, and so we'll put it on as a practice trade and follow it through. So hopefully this will be a first for those of you that are brand new and have just joined us, and we'll see how this thing plays out. But I like it so far. I really do. So that's all I have for you tonight. Like I said, there might be one more update before the week is over. If not, don't be angry. We did get 2 in this week, and there's just nothing else for us to talk about. But if we make another move on this thing, or if I see another move that I think is beneficial to us, I'll definitely do a short little update and throw it in there. But unless the market bounces really hard, we probably won't do anything else. And if the market does bounce really hard, we'll sell some calls. But that's it, folks. That's all I have for you right now. And I hope you all are enjoying this. Those of you that have been around a while, those of you that just signed up, welcome. And I think you'll find this information very helpful to your future as a trader. So it's fun stuff. It really is. It really is one of the most enjoyable and profitable, if you can do it right, things in the world. So I really enjoy this, and I enjoy sharing it with folks like yourself that enjoy it also. I've said many times, trading is a pretty lonely endeavor. It's something local people that I know have no interest in, so can't really talk to anyone about it. My kids get bored with it when I try to talk to them. So I guess when you're 10 and 6, that happens. But that's all I have for you. Everyone have a great night, and I'll catch up with you around the corner. See you all later. Bye-bye.